Hello, my name is Mike Swanson, and the odds are you're watching or listening to this update because you got an email from me telling you about it by being on my free email list. Now, if you're not on that email list, you need to get on it because every single morning before the opening bell, I'll send out an email with a link to my blog post with some what I'm looking at in the markets when it comes to charts, maybe sometimes a trading idea, even a stock pick. And also, the email contains the most important stories of the day that I'm watching that I believe you know about. So if you're not on the email list, click the link associated with this video and subscribe in particular now, because there's a lot of interesting things happening you need to be updated about going forward here. Today is an interesting day for the markets, and there's something happening this week that I think is the most interesting single move I'm going to show you that's taken me by surprise. I'm not that shocked that the market is down today. It was down yesterday and it went up 5 days in a row. Actually, might have been more than that without any dip at all going into yesterday. Basically a floating up market. And that's kind of been the story overall for the market averages since November, except for two little hits that the NASDAQ took in March and then I think it was in May. But the averages themselves are doing fairly well, obviously. It's an up year. But this week, some fascinating stuff's happening in the bond markets I'm going to show you in a second. But I'm not that concerned, I want you to know, about today's drop in the stock market because we're about to enter earnings season at the end of this month. In fact, I think next week we're going to get earnings from the banks led by Bank of America. And typically, individual stocks will go up into their individual earnings reports as traders buy the rumor of good earnings to come, and then some will sell as the news comes out. So typically in earnings seasons, you get bumps into earnings season and small dip or downward. Some selling pressure happens. So I think that's the most likely scenario. I don't think today is the start of some mega drop in the market. Look, the earnings are going to be good. Everyone knows that because the comparisons are with 12 months a year ago. And obviously the U.S. economy is much better than it was 12 months a year ago. We're in a expansionary reopening phase. And it's powerful stimulation and growth momentum compared to where we were a year ago. That momentum is likely to peak in this quarter, but that doesn't mean we're going into a recession. It just means the growth rate is going to peak out. But today, that's I think a reason to be selling stocks. Look, the market is it's prone to pull back on any given day. If it kept going up and up and up, I'd be very concerned that we're reaching an extreme overbought top. And that's still a risk that it could come in the next couple of weeks or next couple of months that we've got to be on guard for. I've explained that in a blog post. But today I want to talk about the most interesting single market move this week. It's not the U.S. stock market. It's not the gold market. It's actually what's happening inside the bond market. Bond funds are rallying. I'm not that shocked about that, but I am surprised at the extent that the rally has taken bonds and caused declines in interest rates. So let me show you a couple things that I'm looking at that make this clear. So this is a couple of the headlines today. Dow drops 250 points. Bitcoin drops. Bitcoin is not a safe haven. Bitcoin is like a call option on the NASDAQ. When the NASDAQ goes up, Bitcoin goes up more. When the NASDAQ pulls back, Bitcoin goes into a crash. It's not a safe haven. It's just an instrument of price speculation. But it's the bottom headline that's fascinating because today, the 10-year Treasury yield dipped to 1.25. If you can remember in February, the yield was rising at one above 170, and people at that time were worried, oh, is the yield going to 2? And the stock market was fading on that because higher interest rates would be negative for the stock market. And in fact, the dip in the NASDAQ of over 10% that happened in March coincided with interest rates on the Treasury in the Treasury bond market ticking up to over 1.7 on the 10-year yield. Now it's gone back down. Who would have thought back then that it would be going to 1.25? But it is. Why? This says concerns about economic growth and the COVID variant that's hitting different parts of the world. In fact, today there was news this morning that Tokyo, it's going to have its Olympics, I think in 10 days. No spectators at those Olympics, none. It's all going to be pure television. So that has people worried. There's increases in cases in the United Kingdom. However, the United Kingdom is not stopping its laxing of the restrictions on the virus. They're doing more openings than we're not the situation we were a year ago. The virus, I would say, is not what it was a year ago in most of the world. But the markets are moving and doing what they're doing. So what surprised me this week is the extent of the rally in TLT. Today, it got above its 200-day moving average. That is the green line in this chart. I was expecting a move in TLT. In fact, in June, I bought the TLT ETF right before it broke 140 for a short-term trade. Because it looked to me like, okay, we got a little base, March, April, May, June. I pointed this out in a couple blog posts, in fact, at the time, and it broke out and it's rallied since then. But today I sold that position. I took profits on that trade. It could go up more. I'm not trying to predict exact tops and bottoms, but I sold because it frankly went up more than I expected already. I wasn't expecting the 10-year yield to go to 1.25. The bond funds such as TLT trade opposite to yields. When yields go down, these funds go up. So the fund went up more than I expected. And more importantly, it got overbought with the technical indicators. And my plan when I entered the trade was, okay, this is a trade. Once this gets overbought, I'm just going to sell and get out and not worry about what's going to happen next. My guess is TLT will still hang in there. Other bond funds will still hang in there for the rest of this month. And then they could start to go lower by Labor Day or sometime in September. That's what I'm expecting. In fact, I may take short positions against these funds in some way or another later, because I think these funds are actually in a giant, massive secular top. But look at this chart. See the RSI indicator? That's at the top. RSI went above 70 about 2 weeks ago, and then today got above 70 again. That's an overbought reading. Boom, I used that to exit. And today it looks like a potential top because this ETF it gapped up on the open, and then as at the moment is trading for a low of the day. A potential reversal, but still, I don't, my guess is it'll hang in there for several weeks, if not a month or two. But I took my profit on the trade. If you're doing short-term trades, that's what you got to do. You enter with an idea of, okay, if I'm wrong, this is where I get out, which for me was, let's say if it fell to 135, I think I got in like 139. And then when do you get out? Well, for me on this trade, I'm getting out when it's overbought, probably in July, and there we are. So exit. Doesn't mean every single trade works out the way you want, but you got to have a plan for every trade you do. That was my plan on this trade. But let me show you a longer term chart. Oh, and here's the 10-year yield too. It isn't updated for today's data, but this is really important. So you can see it got to 1.7 in March. Today it's like 1.26, right at that 200-day moving average. But what's important is the long run. That's the 20-year chart of this. is one key factor. You see, when the stock market crashed last year in March, bond yields collapsed too. And they hit this, the Treasury bond yields hit the lowest low they had ever made and made a double bottom, under 0.5 for this. That's a secular bottom. I don't think we'll ever see that low ever made again. So whenever I do try to trade or make a decision in regards to the bond market, it's always put in context of that big trend, which is we made a secular bottom last year. And that means that when I go long bonds, which I just did and got out of, I'm only thinking of that as a short-term counter trend move in what is now really a long-term bear market that hasn't even really gotten going. Really we're in some sort of top, most likely, for bond yields. We've come down to, from the high of 1.7, but I think we're going to hit a major, when this move rally ends, I think it's going to be a major top, a good way to short these bond funds, because they'll be making what should be critical tops at some point in the next, let's say, 2 months. So this is a situation I'm going to be keeping my eyes on very closely. So remember, TLT tends to trade opposite of this yield, which made a secular bottom last year. So when we look at TLT on, let's say, a 6-year chart, you can see that it topped out last year and then came down to 135. Then we rallied back up to the 200-day moving average. And I believe we're going to top here over the course of the next few weeks or next few months. So that's what's going on. But another thing to talk about is why. Why did this rally happen? What does it mean? Well, that CNBC headline said that people now that are buying the bonds today are worried about global economic growth. I think there's another story too. That's the inflation story. Just as bonds made a secular bottom last year, commodities made a secular low too. In the spring, we saw negative trading in the oil futures market, and oil has done very well. Since then, it's gone to $70, when for a day or two, it was actually negative. Energy stocks have been some of the best performing stocks since Thanksgiving. However, if you think back to like 2 months ago, there's all this talk in the financial media about inflation. CPI numbers are coming that are going to be scary. They came, and the Fed had to talk about it and try to damp down these worries about inflation. But look, what happened in the commodity market, and just as I believe that bonds are in some sort of secular bear market now, when we look at commodities, they made secular bottoms last year, but they have rallied so much since that they're working off that rally, an extreme overbought condition, by going now in some sort of sideways trading range. And this rally in TLT, which really got going in May up until, let's say, that's when it really started, it coincided with a short-term top in this fund, GCC, a broad-based commodity fund. So the upward momentum in the commodity market, just as it hit all the headlines on CNBC and other places, actually made a peak. The momentum halted. In fact, some individual commodities dumped after having made epic runs, such as lumber. So in a certain sense, the worries about inflation kind of went away as the commodity market reached a peak, and that caused bonds to go up, because if there's risk of inflation in the way these people are thinking, then the yields should go down, so I'm gonna buy bonds. So in a way, the action in bonds, it's not simply all of a sudden today all these people think the economy is gonna not be as good. It's what's going on with regards to inflation and commodities, and they made what I believe is a short-term top and are now consolidating. But I think it's a pause, which means it's a buying opportunity to buy commodities, commodity-related stocks. The best time to buy when something's in a bull market is when it dips, when it's going through a consolidation, and so forth. So I think the move in bonds that we've been seeing has to be understood with a simultaneous pause in what had been a huge rally in commodities. That rally kind of hit speed, the brakes got put on it, and then bonds began to move. So that's what's going on. And it also, I think, explains much the reason why gold has also had that pullback that we saw in June and is in the process of trying to stabilize this month to prepare for another rally. So that's what's going on there too. So this is what's going on in these three key markets: bonds, commodities, gold. And today, looking like a top, at least, an overbought top. Look at on TLT, would also suggest that, on this commodity pullback, we're probably seeing, the bulk of the declines when it comes to price. That doesn't mean that the consolidation or correction is over in regards to time, but I do think it is in regards, for the most part, when it comes to price, when it comes to these various individual commodities. So these are my thoughts for today. And if you have come to my videos for the very first time from YouTube, click the subscribe button on my YouTube channel and then click the bell. And then YouTube will send you an alert the next time I have a video up for you to take a look at.